Saurabh Mukherjea is joining us from Marcellus. Saurabh, thanks very much for your time. Good morning. Good to have you after a good Diwali break, right? And let's start our discussion with the area which you've been analyzing for a very long time. Their loan book, their evolution and their growth, Bajaj Finance. It has been in the eye of the storm, earlier with a rap on the knuckles from the RBI, and now, of course, the change of risk weightage due to massive growth in the personal loan side of the unsecured book. Is it a big worry? Is it digestible? How do you analyze it? And what does it do to the stock?
So look, I think I wouldn't lose too much sleep about the RBI rap on the knuckles. My reckoning is it's at the most going to impact around 2% of Bajaj Finance books, and if the Bajaj BAF management expeditiously deals with the issue, the impact on full year profit should be hopefully less than 1%. So it's a wrap on the knuckles, as you say, but I'm not so sure it's that big a material impact on their FY24 profitability. I think the central bank should be lauded for trying to cool off the personal loans mania that had gripped India over the last 12 months. We were going bonkers as a country doing this personal loans business, 30-40% loan book growth in many places. We'd written a note about it for our clients around a month back saying this is getting overdone in India. Credit to Bajaj's management. BAF said in its Q2 results around 3 weeks ago that they were already pulling back on personal loans. So credit to RBI. RBI's move yesterday, I reckon, will increase cost of funding for NBFCs by around 50 bips. Bajaj is well capitalized. They've raised another fresh round of capital recently, so they'll be in good shape. But I think at the system level, we should see a cool down in this personal loans mania that had gripped India. For our part, we've reduced the weight on Bajaj in our portfolio after the Q2 results. After the Q2 results, we reduced Bajaj. We increased the weight in HDFC Bank in our portfolios, in our large cap portfolio CCP. We switched a decent amount of money from Bajaj into HDFC Bank. And we'll carry on being large Bajaj Finance shareholders. It's been one of our best performing stocks since we started Marcellus 5 years ago.
Saurabh, hi, morning. Diwali is also the time for cleanup. Any additions or deletions? I know you just talked about Bajaj Finance and HDFC Bank, but something that you may have completely exited from.
Right. So in our small cap portfolios, Little Champs, we've exited Amritanjan over the last couple of months. It's been a stock that we've held for the best part of 4 years. But post-COVID, the K-shaped recovery has meant that both their balms business and their sanitary napkins business really hasn't got going. So it's a good company. It's a 110-year-old franchise. We wish them well. And hopefully one day again, we can consider owning Amritanjan. We've built a position in Little Champs in a company called PDS. They're a sourcing platform for Western retailers like Walmart and Matalan and Primark. They help Western retailers buy clothes in places like Bangladesh and Sri Lanka. It's been a company which has been around for a decade or so. It's after COVID that we noticed how powerful this platform is becoming as the big Western retailers switch their apparel sourcing from China to other countries like Bangladesh and Sri Lanka. PDS acts as an intermediary. We've also built a position in a company that we used to own 4 years ago called Cera Sanitary Ware. It's number two in sanitary ware in our country. It's always been a well-run business. What's been really remarkable about Cera is the working capital cycle has reduced from around 110 days 5 years ago to 70 days now, which means cash flows have jumped up. And as we get into the advanced stages of a real estate recovery, I think sanitary ware as a sector will do well, and hence Cera Sanitary Ware has become one of our new holdings in Little Champs.
Yeah, just wanted to get a sense from you on Trent as well. I see that also one of the recent additions. Not worried about the valuations at all?
Right. So in Trent's case, you got to keep in mind 3 things on the valuation. So when the market says it trades at 110 times PE, I'm always circumspect on PE. There are 3 reasons why PE in this case is relatively useless. Firstly, remember the Indas rules mean that every time you take stores on lease, you have to hit your accounting earnings, your declared earnings with an amortization hit. So it's a non-cash hit. It's not really relevant, but courtesy the accounting rules, you have to depress the published accounts, but it's a non-cash hit. So we adjust earnings for that. Secondly, our reading is Star Bazaar, their grocery format, is on the mend. We reckon in the next few quarters it'll turn profitable. We've been visiting a lot of Star Bazaar stores over the last 6 months, and so therefore we are baking in Star Bazaar profits which are not in consensus numbers. And the third piece is on their Zudio business, which has been their big story post COVID. We think same store sales growth here will be considerably faster than what the rest of the market is expecting. So our reading is this company's real P, the actual P rather than the market, the P that the market looks at, is somewhere around 50 times. As I've always said, when you look at franchises of this quality, 50 times PE is an attractive level for us to enter. So much like Titan 20 years ago, was basically a watches business. Over the last 20 years, it's become a jewelry business. Now increasingly it's becoming a sarees business as well, and an eyewear business. We think Trent has many more engines than the market understands it to have. And hopefully over the next 20 years, Trent will give our clients the 2000x that Triton has given in the last 20 years.
Saurabh, do you find it challenging right now to look for, pretty fairly valued ideas with, very high degree of risk reward and margin of safety? In the same breath, I'd like to talk about one area of the market which has massively underperformed last 5 years, and people have completely ignored it, don't want to touch it with the barge pole now, which is chemicals. Is there reason now to start getting constructive, even marginally, or not yet?
So look, for our style of investing, I think this is a pretty good time. Remember, we've underperformed in most of our products over the last couple of years because of our quality orientation, because of the orientations of the sorts of stocks you guys are showing on the screen. We've underperformed in most of our products over the last couple of years. Earnings growth for our companies has been around the 20% ballpark, but share price compounding for our companies over the last 2 years is basically close to zero. So you basically had earnings going up by, say, 45% cumulatively, but the share price hasn't gone up, which is why the PE has derated. The run-up in the last couple of years has been around, say, PSU stocks, metals and mining, power and infrastructure, the oil marketing companies. So the kind of lower quality names in our country have done well over the last couple of years. Our companies have taken a back seat, which is why we're finding it relatively easy actually to find high quality companies. I gave you an example of Sarah Sanitary Ware. We're finding it relatively easy to find high quality companies, which we are adding to our portfolios. You'll hear about other additions over the next couple of months. On your specific point on specialty chemicals, yes, the post-COVID world, especially China returning and beginning dumping with vengeance from May this year. China began dumping on global markets with vengeance, has hit the earnings of specialty chemicals companies, including several of our holdings such as AN Alkyla Mines. Our reading is that over the last couple of months, we haven't seen the Chinese crash prices. So from May through to September, the Chinese cut prices by around 25%. That's hit our companies. I think Alkyla Means, for instance, have said they're considering an anti-dumping, taking China to WTO for dumping. So last 6 weeks, we haven't seen the Chinese dump. And what we are trying to figure out, Ajay, is this a good time for us to increase our positions in specialty chemicals, given that the Chinese dumping seems to have abated and the earnings have been impacted. The first half earnings for specialty chemicals companies have been impacted. We're trying to figure out, is this a good time to ramp up our positions in specialty chemicals?
Saurabh, what about real estate as a pack? I'm not sure if you have too much exposure there. Are you willing to completely be away from that theme?
Yeah, we don't buy real estate developers. Doesn't make any sense. There's too much interface with the government.
And playing it through that?
There's too much interface with the government apparatus, right? It's very difficult for real estate developers in our country to make money, given that they have to constantly interface with local government, state government, and so on.
Right. Sort of a lot of chatter in the market as well around, state elections and then, of course, the general elections as well. Is there merit in taking a tactical position? And if so, what would it be?
It's good fun to watch these things, but I'm not so sure how we can make money here. One of the most paradoxical things about these election campaigns which are underway, right, is on the one hand, we read in the newspapers every day we hear on your on your channel every few weeks that unemployment is supposed to be falling in India. There's plenty of job creation, and yet every party, every political party in all the states that where campaigning is happening is basically promising cash doleouts. So money seems to be falling from the heavens as far as the political parties in our country are concerned. So clearly there is distress in the voters, in the vote banks that these parties are trying to pander to, and it's a very sort of incongruous situation. On the one hand, we are told that unemployment is crashing in our country, 10 million jobs, 15 million jobs per year are being created. But clearly in MP, Chhattisgarh, Telangana, Rajasthan, something else is happening because every political party is campaigning around how much money they will give to the poor. And I'm trying to figure out which story should I believe in, and that makes the job of trying to figure out, can you capitalize in political cycles that much harder, Aisha.
Saurabh, have you analyzed the entire wires and cable segment closely? Markets seem to have fallen in love with this segment, especially the top 4-5 stocks, but at the same time, they don't come cheap, 40-50 times plus. Is it the scarcity of names, just about less than 4-5 names? Would you touch it or analyze it to make it part of your portfolio going forward?
Clearly an interesting sector. There used to be a time 4-5 years ago where it was say Havells in the north and V-Guard and Bajaj Electricals in sort of west and south, but now there are more names to consider. There's Polycab, there are RR Cables and so on. So it's an interesting space. We've looked at it. We've not been able to identify a company with strong moats, strong barriers to entry. Havells clearly is the sort of preeminent name in the space, and Anil Rai Gupta and team have done a tremendous job over the last 20 years. But we haven't been able to figure out which player to back in cables. I think it's one of those areas where perhaps we need to do more work. I think there will be long-term compounding possibilities available in cable. There's clearly moats to be built around distribution, around technology, around how you supply the channel. It's our challenge to figure out which horse to back in the cables industry.